Passive investing is based on the notion that it is not possible to identify winning stocks on a regular basis. Instead, portfolios should mimic the market, assuming only market risk. PriceTarget Research's value trend ratings consistently identify stock market winners, directly challenging the assumptions underlying passive investing. Welcome to PriceTarget Research. I'm John Lafferty. In this video, we're going to talk about our value trend ratings, the objectives we had when we developed them, the components of the ratings, some passive investing concepts, and performance of our value trend ratings over a multi-decade period. Passive investing is based on the observation that random samples of stocks drawn from a large list perform randomly. Our value trend ratings are anything but random. They regularly identify winning stocks. So let's have at it. PriceTarget Research's value trend ratings measure the overall attraction of a stock relative to the universe. They have resulted in superior multi-decade performance where the high-rated stocks outperformed the average stock and our low-rated stocks underperformed. We had a number of objectives in mind when we developed the ratings. The first being that we wanted to be able to blend deep fundamentals and market signals so that the rating was a blend of the two approaches to looking at a company, fundamental and technical. We wanted to be able to rate all companies in all market sectors, not selected companies and sectors as some rating systems focus on, where, for instance, they'll exclude the financials because the ratings don't work real well on financials. We wanted to find winners and losers, as I said. We have 5 categories, A, B, C, D, and F. The A's being the winners, F being the losers. We wanted the ratings to be well ordered, meaning that the A's beat the B's and the F's underperformed the D's, so that they performed in the order you might expect. We wanted consistent performance from year to year. We did not want to rely on a few good years and the rest being mediocre. We wanted good performance year in and year out. And finally, we wanted performance over long enough periods of time that once a stock had a rating of A or B, it was actionable, not a trading strategy, but where the stock could actually be included or excluded from real-life investment portfolios. The components of the rating are 2, the appreciation score and the power rating. The appreciation score measures the appreciation potential of a stock relative to the universe, and it runs from 0 to 100, with 100 being the highest appreciation score, 0 being the lowest. The appreciation score is derived from the CFROI valuation metric to develop the price target, and then the appreciation potential is measured by taking that price target and relating it to the current price. So in the example, the stock is at 72, the price target's 100, so that's about 39% appreciation possibility. And when we looked at the overall market, it got a score of 62, meaning that appreciation was better than about 2/3 of the universe. The power rating takes into account market signals. Again, it looks at the timeliness of a stock, 100 being the highest, 0 being the lowest. In this example, the stock has a power rating of 81, and that power rating is based on the stock's price performance, performance of companies in the industry, and behavior of analyst expectations. In other words, are analyst expectations rising or falling? And taken together in this example, the power rating is 81. On the grid, then, you can see the horizontal axis being appreciation score, vertical axis being the power rating, that if the two scores are both favorable, the company ends up in the upper right quadrant and is viewed as a buy. The two factors agree in a positive way. If they agree in a negative way, if the appreciation score is low and the power rating is low, then the stock is rated D or F, something to avoid. So these are cases where the two scores agree with each other. In cases where they don't agree with each other, take for instance the case where the appreciation potential is positive but the power rating is low, these are more in the gray area, likely to be middle of the road C ratings. So in this case, you have a case where with the positive appreciation score but the negative power rating, you have to call into question the forecast underlying the price target. And conversely, if the appreciation potential is low but the power rating is high, it's saying that the market may be overly enthusiastic about the company's prospects relative to what the forecasts and fundamentals really show. To implement the value trend ratings, we created a grid just like the one in the last couple of slides, with the appreciation score on the horizontal axis and the power rating on the vertical axis. And the upper right-hand quadrant in green is all those companies whose appreciation score and power rating are sufficient to generate either an A or a B rating. And the red area at the bottom left is all the combinations of appreciation score and power rating that would generate a D or an F rating. The white area in the middle is neutral. About 40% of the stocks are neutral at any given point in time. 30% are buy rated, 30% are sell rated. And we call this the PriceTarget Research rating map. It appears in all of our research and is a visual aid to help understand why a value trend rating falls where it does at any point in time. You can see as an example from the discussion of the appreciation score and the power rating, with an 81 power score and a 62 appreciation score, 81 power rating and a 62 appreciation score, the overall rating, the value trend rating, is B, comfortably into the buy zone. Developing ratings, one of the things you have to take into account is the arguments that are made, certainly in the academic community, that no systematic approach to identifying stock market winners and losers can be successful. There's three forms of the argument. The first, usually called the strong argument, is the random walk theory, which says that the past stock prices cannot be used for a given stock to predict future stock price movement. The stronger argument, the efficient market hypothesis, extends the argument, says that it's impossible to beat the market through stock selection because all known information is already embedded in stock prices. And therefore the price of a stock at a point in time embodies any knowledge that could be gained from equity research. The third argument, typically called the strongest, is modern portfolio theory, which basically says that the performance of given stocks is a function of two kinds of risk. Risk specific to the individual stock itself, and then market-related risk. And that the only way to outperform the market is to take on increasing amounts of risk, which is a sophisticated way of saying you can't find winners and losers without betting the ranch, if you will. The evidence that we've identified that we think is important in thinking about passive kinds of investing. In looking at all of the research underlying the efficient market hypothesis and the random walk, typically it relies on the selection of a random set of stocks from a much bigger list, which strikes us as kind of a tautology. If you take a random list of randomly performing stocks, chances are you're going to end up with random performance. And we think that's what a lot of the research is really focused on. In contrast, the value trend rating helps us focus on the tails where the action is. At any point in time, for most stocks, nothing of significance is happening, and therefore the performance going forward from that point is likely to be average. On the other hand, using the value trend rating to find extreme situations of either significant potential, positive potential, or negative potential, and focusing on the tails, it's possible to identify companies in either direction undergoing significant change and implement them in a portfolio strategy. So the value trend rating finds companies at stages in their life cycles where they are either entering a period of significant positive change or negative change. Looking at the performance of the value trend ratings, we went back to 1985 when we first started publishing the ratings. We organized companies into stocks into groups based on rating every 3 months, A's through F's, and then measured performance for the next quarter. The ratings were drawn from our historical database of ratings. They were contemporaneously assigned at each point in time. They were not created currently and then applied retroactively. And they're based on concepts which have stood the test of time. The CFROI valuation methodology, some work we've done on tracking analyst expectations, stock price performance, the performance of industry groups. And the result, the value trend ratings have generated significant long-term investment performance. You can see from this chart, hard to read the numbers off it, but it's a cumulative return chart. You can see over that entire 35-year period, 1985 through 2019, the A's beat the B's and both beat the C's. The D's and F's significantly lagged the C's. You can see the universe from which the ratings were drawn in the S&P. It's interesting, the S&P outperformed the universe over this period of time, which is a commentary probably on the performance of big stocks versus little stocks. In terms of cumulative performance, you can see the returns from the A's and B's dwarf the returns from the C's, D's, and F's, and we're significantly better than the universe as a whole. And if you want to look at it in terms of an annual average result, you can see that the A's and the B's returned average annual returns in the 600 or 700 basis point range relative to the average stock, and the D's and F's underperformed the average stock by 600 or 700 basis points. In terms of risk-adjusted returns, the A's and B's had positive alphas, D's and F's had negative alphas. In each case, both groups had betas slightly more than 1, but a significant difference in the risk profile of the value trend rating, highest rated stocks versus lowest rated stocks. So again, the value trend rating has afforded significant returns over periods of time. Obviously, this is not actually a portfolio. It's the performance of the rating categories done in a very systematic way. That's a wrap. Until next time, you can visit us on the web at PriceTargetResearch.com, where you will enjoy comprehensive ratings and research, relentless updates and alerts, peer sector and industry reports, and model portfolios tied to key investment objectives. You can also find more of our videos on YouTube at YouTube/PriceTargetResearch. Finally, you can find our content exclusively at metrics.com.